Welcome to Iron Financial. This is the only place where we forge stronger portfolios by putting the market's biggest claims to the test. I'm your lead analyst. Today, we're doing more than just looking at a couple of stocks. We are grabbing our hard hats and conducting a full structural analysis of the American retail economy. We're going to get our hands dirty, look at the blueprints, and figure out once and for all if this sector is a solid bedrock for your capital or if it's built on nothing but shifting sand. And I'm your market skeptic. You know, you can't ignore the noise out there. Every headline is screaming about stubborn inflation, a consumer that's stretched thin, and a housing market that's under some serious pressure. So the question we're asking today is simple, but the answer? Well, the answer is absolutely critical for your money. Are we standing on a foundation of solid granite, or is the ground beneath our portfolio about to turn into quicksand? That is what we are here to find out. We're going to cut through all the corporate speak and give you the real structural integrity report. All right, let's get to work. Every good analysis starts with a blueprint, and this is ours for today. First, we're going to start by forging the foundation, really setting up our framework for how we're going to attack this. Then we're going to stress test the two most important components, the landlord, which in our case is Urban Edge Properties, and the tenant, home improvement giant Lowe's. We'll inspect their recent acquisitions to answer a key question. Are they actually reinforcing the structure, or are they just buying a whole lot of trouble? Then we'll get into Lowe's 2026 blueprint to see if their plan for the future holds any water. And finally, we'll bring it all together to deliver what you came here for, the iron verdict. To really understand the strength of any building, you can't just look at the walls. You have to inspect the foundation and the structure sitting on top of it. That's the exact approach we're taking today. Think about it. You could own the best piece of real estate in the world, absolute bedrock. But if your tenants can't pay the rent, the whole thing is worthless. On the flip side, even the strongest, most profitable tenant can't survive if its foundation is crumbling. For our analysis, the landlord, the bedrock, is a specialized retail real estate company, Urban Edge. And the tenant, the actual building on top, is none other than Lowe's. Okay, so let's start with this foundation, Urban Edge. Now, if you listen to their pitch, they'll tell you they're a fortress, a high-quality portfolio in only the best locations. But let's be real. In today's market, commercial real estate has become a four-letter word for a lot of investors, and for good reason. So we have to ask the tough question. Is Urban Edge truly a defensive stronghold, a safe haven, or is it just another property company that's exposed to the exact same cracks and fissures as everyone else in the sector? Let's stop listening to the story and start digging into the numbers. So the analysis really starts with this one single, incredibly powerful number, $950. That is the average sales per square foot that the grocery stores anchoring Urban Edge's properties are generating. Now, let's be crystal clear. This isn't some rosy projection or a hopeful estimate. It is a hard metric of pure productivity. When your main tenants, the ones that draw everyone in, are pulling in that kind of revenue, it creates a powerful gravitational pull. It drives foot traffic for the entire shopping center. This is the very first indicator that tells us we might be dealing with a truly high-quality, resilient portfolio. It's the first sign of a really, really strong foundation. And right here, this is the data that builds the entire bull case for Urban Edge. So let's really break it down piece by piece. Their portfolio focus isn't just scattered randomly across the country. No, it's laser-focused on the DC to Boston corridor. Think about that for a second. That is the most densely populated, wealthiest region in the entire United States. The average population within just a 3-mile radius of their properties is 200,000 people. That is the highest density in the entire sector, period. Then you see that a staggering 80% of their properties are anchored by those high-performing grocery stores we just talked about. We're talking necessity-based retail. People have to buy food no matter what the economy is doing. Occupancy, rock solid at 96.7%. And their balance sheet, the thing that can sink any real estate company, net debt to EBITDA is at 5.8x. For a REIT, that is a very healthy, very manageable leverage ratio. This tells me they're not some speculative play. They are a defensive one, built on the twin pillars of density and necessity. So the big question is, how do they maintain this level of quality? It's not by accident. It's through a very disciplined strategy that they call strategic capital recycling. The concept is actually pretty simple, but it is incredibly effective. They systematically identify and sell off their non-core, lower-growth properties. Then they take that capital and redeploy it. They recycle it into acquiring high-quality shopping centers right back in their prime target zones. It means they're constantly pruning the portfolio, cutting away the dead wood to reinforce the core structure. It's not passive, it's proactive, intelligent asset management. Whoa, hold on a minute. This is exactly where we need to apply some serious pressure. The strategy sounds great on a slide, but these numbers right here tell a much more complicated story. They're selling assets at a 5.2% cap rate, and they're buying new ones at 7.1%. Now, for everybody at home, the cap rate is basically the yield you get on a property. A lower cap rate, like 5.2%, typically means it's a higher quality, safer, more desirable property. A higher cap rate, like 7.1%, well, that usually implies more risk. So the billion-dollar question is, why? Are they some kind of geniuses who are uncovering hidden value that the entire market has missed? Or are they just chasing yield? Are they moving down the quality ladder, buying properties that need more work or in slightly less prime spots, and taking on more risk just as the economic storm clouds are gathering? That 1.9% spread isn't just a number. It's a measure of risk, and right now, we need to know if it's a risk worth taking. You know, that's a critical point, because a granite foundation doesn't mean a thing if the building on top of it is about to collapse. And that brings us perfectly to the tenant, Lowe's. They've just reported their latest quarterly numbers, which gives us a direct, unfiltered look into the health of their business. So, let's get into it and see if their structure is as solid as Urban Edge's bedrock, or if we're about to see some serious cracks appear. This chart, right here, shows you the core conflict in the Lowe story. It's the whole bull versus bear case in two simple bars. On the one hand, you have the top line, net sales, and that number looks strong. I mean, really strong. They grew from $18.6 billion to $20.6 billion in the fourth quarter. The revenue engine is firing on all cylinders. But then you look at that other bar, the bottom line profit that actually belongs to the shareholders, the GAAP diluted earnings per share. That number went down from $1.99 last year all the way down to $1.78. So they are selling more stuff, but they are making less profit per share. And that is a major red flag. There's an old saying on Wall Street, revenue is vanity, profit is sanity. And right now, it looks like sanity is taking a pretty big hit. And hey, don't just take my word for it. This quote is straight from the top, from the chairman and CEO Marvin Ellison himself. Read it carefully. The housing macro remains pressured. That's carefully crafted corporate speak for, we are sailing directly into some very serious headwinds. He is admitting right there in the open that the overall environment is tough. When the captain of the ship tells you the seas are getting rough, you would be an absolute fool not to listen. This quote is a clear admission that the external environment is a significant crack in their foundation. They're trying to control what they can, but the storm is raging outside the walls. This is the crucial point, and it's where we, as analysts, have to look deeper than that ugly headline GAAP number. Yes, GAAP EPS was down over 10%. That's bad. But look over at the adjusted EPS. It was actually up 2.6% to $1.98. Now, the company argues that this adjusted number is a truer, more accurate reflection of the core business's health because it strips out what they call one-time costs. From this perspective, the operational muscle of the company is actually still growing. But that, of course, brings up the obvious, skeptical question. What exactly are they adjusting out of these numbers? Are these truly legitimate one-time expenses, or are they just hiding real operational problems under a convenient accounting blanket? And that is the perfect transition. The big difference between those two earnings numbers, the entire reason for that adjustment, comes down to one word: acquisitions. Lowe's has been out there making some major purchases, and they're framing them as strategic investments to accelerate their total home strategy. Specifically, they're trying to win over the professional contractor, the pro customer. So the bull case here is that they are laying the expensive groundwork now for future market dominance. They believe that by spending heavily today, they're building a much larger, more profitable structure for the long term. Specifically, they went out and spent big on two key companies: Foundation Building Materials, or FBM, and Artisan Design Group, ADG. Now, let's be clear, these aren't small, tuck-in deals. FBM is a massive distributor of specialty building products. We're talking drywall, steel studs, insulation, the heavy-duty stuff that big contractors buy in bulk. And ADG is a huge dealer in flooring, countertops, and cabinets for builders. These acquisitions are designed to give Lowe's a direct pipeline to large-scale residential and commercial projects. This is their big move to get beyond the weekend DIY warrior and deep into the territory of high-volume, repeat business from professional home builders. $149 million. Let that number sink in for a moment. That is the pre-tax cost tied to these acquisitions that hit their books in the fourth quarter alone. That is the adjustment. So is this the kind of heavy lifting that will pay off for years to come? Or is it a desperate move to buy growth? Are they simply buying revenue to make the top line look good while they're actually destroying shareholder value on the bottom line? Spending this much money when your own CEO is openly talking about a pressured macro environment is a very, very high-stakes gamble. This isn't just a simple renovation. It's a massive, incredibly expensive expansion project happening during a potential housing downturn. It is a gamble. Absolutely. No question about it. And just like any major construction project, we need to look at the architect's blueprint to see if the plan even makes sense. And that's exactly what the company's 2026 full-year outlook is for. This is management's promise to Wall Street. It tells us whether they believe these heavy, expensive investments are going to start paying off, and more importantly, how soon. So let's put on our glasses and inspect these plans. So here it is, the 2026 blueprint. Now, the headline number, total sales, that looks massive. They're projecting somewhere between $92 and $94 billion, and they're guiding to an adjusted EPS of over $12 a share. On the surface, that looks like a pretty solid framework for future growth. But my eyes are immediately drawn to two other lines on this blueprint that tell a different story. First, comparable sales. Their forecast is flat to up just 2%. In an inflationary world, growing at 2% is basically treading water. Now look at the costs to achieve even that mediocre growth. Capital expenditures of $2.5 billion. So let's be perfectly clear. They are spending a fortune in capital to effectively stand still on a same-store basis. That raises some very serious questions about the return on their invested capital. Is this a blueprint for a skyscraper, or is it a blueprint for a money pit? All right, we've done the work. We've inspected the foundation with Urban Edge, and we've examined the entire structure with Lowe's. We've seen the solid bedrock, and we've seen the very costly, very risky renovations happening on top. Now, it's time to bring these two analyses together, step back, look at the whole picture, and deliver the iron verdict. So the bull case, the solid rock argument, it's pretty clear. You have a best-in-class landlord in Urban Edge sitting on defensive, high-performing, necessity-based assets. And on top of that, you have a tenant in Lowe's that is still growing its top line and is aggressively investing in a coherent strategy to win the very lucrative pro customer. They are building for the future. But the bear case, the shifting sand argument, is just as compelling. The macro environment is, by their own CEO's admission, pressured. Lowe's GAAP profitability is shrinking, and these incredibly expensive, debt-fueled acquisitions are a direct and painful hit to current earnings. They are spending billions of dollars, but the immediate return just isn't there, and the big payoff is promised somewhere down the road, after we get through this economic storm. That's a whole lot of risk to take on right now. So let's summarize the key takeaways from our deep dive structural analysis today. First, the landlord Urban Edge appears to be built on solid rock. Its foundation of high-density, grocery-anchored real estate seems very well defended against economic turbulence. Second, the tenant Lowe's is showing impressive resilience on its top-line sales, but there are undeniable signs of stress and pressure on its bottom-line profitability. And third, and this is the most critical point, the tenant is undergoing a massive, expensive, and risky renovation through both acquisitions and heavy capital spending. This heavy construction is happening in a very tough economic neighborhood, and its eventual payoff is far, far from guaranteed. So we've laid out the blueprints for you. We've run the stress tests. The structure of American retail, when you look at it through the specific lens, has a very solid foundation, but a very expensive and uncertain building project happening on top. The final question, as always, is for you. Now that you've seen the analysis, is this a generational opportunity to start building your position while everyone else is running scared? Or, with those storm clouds gathering on the horizon, is it simply time to take cover and wait for all this heavy, expensive construction to finally be finished? The choice is yours.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.